Good afternoon and welcome to this week's Halftime Talk. We're honored to be joined by Mr. Martin Fraenkel, the president of S&P Global Platts. Good morning, Martin.
Hi, Sean, and thanks for having me. It's a pleasure to be here.
Martin, I suppose we're starting a new quarter after what has been an absolute unprecedented 3 months for all sorts of the obvious reasons. But within the energy markets, no less, we've had a pretty steep V, a big collapse, and then one would have to say a pretty sharp recovery, at least up to into the $40 mark. How do you see the journey of the oil markets at the moment? We seem to have kind of plateaued a bit.
Yes, I think that's right, Sean. I mean, really, when one thinks back of this second quarter, you and I, we've been around for a while, we've seen a few crises, but we've never seen anything like what we've seen in the second quarter, and especially, in fact, for oil and energy markets more broadly. Obviously, the COVID crisis dwarfs anything in terms of what any of us probably have seen in our lifetimes, and the impact on oil demand, which has been truly, to use that overworked word, unprecedented, but it really has been unprecedented.
It's hard to find another word, even though I have looked up the thesaurus. Unprecedented just about is the right one. Yeah,
no, that's right. And maybe it's unprecedented by its unprecedentedness.
Exactly.
Sure, but when you look at the numbers and the size of the drop in demand, it's just it's something that none of us ever envisaged. And then, of course, we had that, and we almost forget about that now. That particularly at the beginning of the COVID crisis, it coincided with the dislocation of the OPEC plus agreement, and the price war which ensued. So we had a massive supply side disruption as well. So these twin crises, just as far as oil markets were concerned, as we were kidding, been unprecedentedly unprecedented, and they really have. Mm-hmm. So if you look at it in that context, and as you say, the end of the second quarter, I mean, the oil markets have really done a remarkable job of stabilizing. As an industry, our markets and looked into the abyss, and to find ourselves at the end of Q2 talking about $40 a barrel, Brent is relatively speaking stabilized, I would say.
If you look at the two kind of pieces there, Martin, you referenced the March window from, let's say, the end of IP week to before the COVID really hit us all over the head. There was that market share war, the collapse of the Saudi-Russia alliance on the OPEC plus. What is your sense about the outlook for that alliance? Is it continue to be necessary to keep the market stable? And how fragile do you think it is?
Well, I think it had a big wobble in Q2, right? And we saw the consequences of that wobble, particularly in the context of the collapse of demand. And to be fair, the alliance really regrouped pretty effectively, and has succeeded in cutting supply really to an unprecedented level. And if you look at most analysis at the time, and I wouldn't exclude ourselves from that, we all thought it would take longer for the supply correction to come. So there was a lot of talk about the world running out of storage space. Famously, WTI expired at what, minus 40 plus on April the 20th, because, you know, of the fear that there literally was nowhere to put the oil. So you know, the reaction from the supply side has really meant that catastrophic situation of, you know, oil having nowhere to go has been averted, and things look a little bit better. And our forecast for the second half of the year is that stock levels gradually get drawn down on, and we're already beginning to see some drawdown on storage, floating storage. Freight rates coming down. So, you know, there's obviously a long way to go. And there are a lot of ways in which the demand side can be, which has started to recover, can be undermined by the economic situation in the world. But things certainly look significantly more constructive at the end of Q2 than at the low point around, let's say, beginning of April.
It did have everything dramatic about the cycle, the collapse, and then the dramatic alliance recovery within OPEC Plus, quicker than expected, you know, more supply cuts than expected. And it strikes me, to a certain extent, everything has been kind of overestimated on the downside. In terms of, even IEA had forecast 30 million barrel collapse in April. It ended up being 25, still massive, but, you know, 5 million barrel of a difference. And then on the upside, the recovery in terms of the willingness for OPEC to cut as they have done, that there has been a little bit of underestimation on the recovery. And I'm wondering, through the second half, will we underestimate the recovery, that demand could be stronger than had initially been thought? What's your own thoughts about that in terms of estimation, underestimating the recovery?
Well, I think you're a tough man, Sean, right?
Well, we've got this weird dilemma. We've got, you know, equity markets are as if it's, you know, 1999. I don't know what the right paradigm is, but ultimately in a massive bull, and yet Main Street is clearly hurting. You know, 10 million people in the UK are being paid their salaries by the government. These are two very contrasting realities. And I suppose every day I wake up, I really don't know which one to be guided by.
Yeah, no, I was going to say, I think you're tough on calling people out on the numbers, right? Because when we're in uncharted territories, everyone's doing their best attempt to sort of to go through the data and to put a number on it, and then one's got to continue to track and update, which is what we try to do at Platts. Look, I think if you look at this this crisis, it's really different from the global financial crisis of 2007, 8, 9. You know, and that was a crisis which came out of the banking sector and affected pretty much every sector. This is a really segmented crisis.
What's S&P Global's Platts view on that gap as you move towards the second half to the end of the year? Obviously, it's an analysis at this moment. A lot can change, but how do you guys see that from now?
Yeah, I mean, we sort of think it's continues to stabilize towards the for the balance of the year, assuming that we don't get big second waves, and that's a big assumption. Yeah. So, you know, we're looking for, you know, Brent crude prices to be towards some $40, so around about these levels towards year end. We think going into 2021, we can continue to see some appreciation in Brent prices. Maybe 2021, by the end of the year, we get up towards $50 a barrel, something like that. You know, but we still see 2021 demand being down on 2019. On 2019, not 2020.
Yeah, yeah. So
To
down from 100.
yeah. So I always have to.
Back there.
Yeah, the numbers and the changes in numbers are so huge that sometimes I have to double read them to make sure
Yes.
that I'm properly getting these things. So it's a cautious comeback, but I think a lot does depend on people's confidence, right? I mean, people want to, in my view, and I think the evidence suggests that people want to get back to normal if they feel safe to do so. I mean, so, this is not an economic argument. I'm not giving you any data about it, but the data supports what I'm saying, I think, and it's what we hear around us. So I think a lot will depend on that. A lot will depend on what happens with a vaccine. Can it be? Will it happen? And how quickly will it be rolled out?
I think there's also a dynamic of, I mean, today, Dubai, we're opening up for tourists again, coming in on Emirates without quarantine requirements. So these are kind of big milestone moments. But ultimately, I think it's how do you physically structure and plan to live with COVID, or how much you're willing to kind of coexist with the impact of COVID. Like in the US, it seems they have an increasing tolerance for a relatively high impact coexisting with normal life. That seems to be a big point. It's hard to quantify that, how comfortable any society is living with COVID.
Well, that's right, Sean. I mean, I think the next few weeks in the US are going to be really important, right? Because obviously the COVID crisis in the US impacted very heavily the New York tri-state area with very, very large consequences for human life in that area. But the impact was pretty concentrated in the US. So now what we're seeing is the spread of the virus in other parts of the US, in the South, in Texas, in Oklahoma, etc., Arizona. So the Florida, of course. So these are, also highly populated areas. I think I read somewhere that, that about a third of the US population is now in areas where the virus is growing very rapidly.
And these are politically very, very critical states in an election cycle. And given the way America does report data quite efficiently, we should have a pretty quick snapshot on how gasoline consumption is going in those areas.
Well, that's right. So, and I think we're going to see. I mean, I think that the rates started to go up fairly rapidly 3 weeks ago. So people have started to comment that that the mortality rate, fortunately, is relatively low so far relative to the infection rate in those states. And there's a discussion about that, and I think we're going to see over the next few weeks whether it turns out that there's a path where you can have high infection rate but low mortality for whatever reason. And I'm obviously not qualified to speculate on whether that would be because of mutation in the virus or because it's in young people or medical advance. That's way beyond my competence, but we're going to see in the numbers over the next few weeks what that means. And I think that will be important, because if it turns out, and obviously mortality rates are lagged indicators, or have been lagged indicators of infection rates, if it turns out that they start to creep up and that impacts people's behavior in a third United States, well, that's probably going to impact gasoline demand and other demand for oil in those parts of the US as well.
Martin, one of the big things that obviously from an energy sector point of view that played out in the second quarter was that famously, as you referenced in your earlier comments, WTI went negative. There was some very serious stress on all of the great work that you guys do and your peer group, the benchmarks. And I'm wondering, you've just done a research report with the Oxford Institute of Energy Studies on how have the Middle East benchmarks in particular, where we are in the world, held up, withstood this COVID test, this massive scale of dislocation and volatility?
Well, I think, Sean, there's a saying in at least in British politics, I think in politics around the world, that when the political advisor becomes the story rather than the politician themselves, that there's a problem, and
it's called the Cummings problem.
It goes, I remember when Alistair Campbell on the Blair, these things come. So I think it's a little bit the same in the oil markets, that we in the price reporting and benchmark and exchange sector, our job is to reflect markets. And the markets are the story, and it shouldn't be the benchmarks, right? So when we've seen events like we've seen over the last few months, it's brought into the spotlight some, and I repeat, some, but not all benchmarks in oil around the world. And I think that is bringing in a period of reflection in our part of the industry, because our job should be to reflect prices and transparency and give that insight to the markets. So I think overall in Platts, we do a lot of introspective work day in, day out. How are our prices reflecting markets? Do our methodologies need to be updated? And, touch wood, we're pretty comfortable with the way our benchmarks have behaved over the last several months. We're very confident that all of our benchmarks, whether dated Brent or whether our benchmarks for crude oil in the US, which stayed positive throughout, which didn't go negative even on April 20th, the day when WTI and other price assessed crudes were assessed negatives. Our crude benchmarks in the US was showing positive numbers. If memory serves me right, around $10 a barrel, which was actual value for crude in the Gulf Coast. So, and that's been the case in the Middle East as well. That it's there's been a lot of discussion around Middle Eastern benchmark crudes, but we're very comfortable with the way, not complacent. I want to say, comfortable is not the same as complacent. We're never complacent.
But confident, nonetheless.
We're our biggest self-critics, because we're having these debates. I was going to say within our four walls, but within our multiple Zooms, I should probably say, every day, multiple times a day, to challenge ourselves as to whether we're reflecting markets appropriately. And our Dubai and our Oman assessments have held up very well over the last few months. So if I may just say, you referenced a paper that my colleagues have just written for the Oxford Institute, and we are members of the Oxford Institute as our many market participants, and it's an outstanding organization. And my colleagues Vera Bly and John T. Rushforth have just published a work which I can only describe as the definitive work on Middle Eastern benchmarks, and it's really an extraordinary piece of work in my view, even for somebody like myself who hopefully knows something about benchmarks and the history of benchmarks. I found it a learning experience. So I'd encourage people to look at it, because it really helps to underline what makes a good benchmark, and where can you see weaknesses in benchmarks? And I think one of the key outputs from this 25 page deeply argued paper is that benchmarks which have got a underlying basket and which allow different mechanisms to come into play in times of stress better than benchmarks which are based on one single underlying. And that's a profound insight, right? And it's a profound insight which is demonstrated by the data.
Which is the case with Brent as well, right?
Well, it's, if you look at each geographical time zone, if crude oil in this crisis in the second quarter, it's been true, right? So WTI at Cushing traded $40 negative because it's got one delivery point at Cushing, Oklahoma, right? And as it turned out, when it came to the expiration of the futures contract, which is a physically settled futures contract, I used to in my past be responsible for that contract. It's a great contract, got huge numbers of positives around it, but it's physically settled at Cushing, Oklahoma. And that didn't stress well for a number of different reasons on April 20th. Whereas an assessed price of US crude in the Gulf Coast did stress well because it takes into account a number of factors. And that's what's reflected. We've launched now at Platts our what we're calling our AGS assessment, American Gulf Select assessment in the Gulf Coast. We think it's going to be the major waterborne benchmark for crude coming out of the US to go.
But we saw spectacularly US crude oil exports into Asia, particularly China, soared in the second quarter.
Yeah, and so you've got now a waterborne benchmark which aligns with Brent, which, as you say, is a basket as well. The AGS, effectively a basket reflecting waterborne crude coming out of the Gulf Coast, wherever it comes from in the US. And similarly, Dubai and indeed Oman, Platts Dubai and Platts Oman, are baskets which allow for alternative delivery mechanisms. And that takes the stress out of the system, right? So what you saw, in Q2 again is that DME Oman went to a big premium to, for example, Platts Oman. And that's because DME Oman goes 90+% to China, reflects the conditions of the desire for Chinese refineries for Oman production, not an Oman benchmark. Chinese refineries want Oman production, and there's some regulation which supports that demand in China. So DME Oman is going to reflect that physical demand for that quality. And, I forget exactly the production numbers for Oman, but it's something like 900,000 barrels a day.
Under a million, yeah.
Yeah, and so, and even in our much reduced production environment that we have, that's of course a relatively small microcosm. So, so these benchmarks get stressed when there's not an alternative mechanism. Whereas, both Platts Dubai and Platts Oman allow the delivery of Waterborne into them. And in the case of Platts Dubai, by far the biggest benchmark in the region, there are actually 5 different crudes which are deliverable into Platts Dubai, which is why they stress well.
Yeah.
It's
one would have to say that I don't know what history will show as the moment in which the energy market sort of reached its ultimate crisis point in the second quarter, as the IEA described, the 2020 the worst year in the history of the energy industry, and the second quarter the worst quarter, and April the worst month. Well, the worst day would have to be April 20th when such a major contract would go negative. Martin, just to wrap up and kind of come back full circle, as we look out to the second half of the year, what is there anything we'd like to sort of think a little bit sort of crystal ballish over the horizon? What people may not be watching enough that you think might come up to be something more than something else? But what do you think? Obviously, the big U.S. election stands out in the second half.
Yeah, the US election does stand out. I remember when I was thinking about this interview, Sean, you hosted me and a number of others kindly for a dinner. I think it was an IPE week of, not of 2020, but 2019. And you asked a similar crystal ball question for 2020. And
we should look back at that.
And I think, and of course, none of us had a clue what was going to happen in 2020. But I do remember saying that, that the first 2.5 years at the time of the Trump administration had been interesting, but next year was going to be an election year, and you ain't seen nothing yet.
Yeah.
And of course, it's turned out really, really different from what any of us could anticipate. But clearly, U.S. politics is impacting a lot of things in the U.S., including the response to COVID and including the potential the impact that has on oil demand in the way that we were describing earlier on. So I think as we go into the second half of the year and right to the end of the year, which will be after the US election, I think it's going to potentially impact both demand and supply in the US, right? The chances are that the two parties are going to go into the election both really different policy responses to the pandemic and to their attitudes to production and the incentives or otherwise which should be given to US domestic production and to the energy transition. So I think as we get closer to the US election, I think those things are going to come into the spotlight, right? And obviously Biden has not yet even been formally nominated by the Democratic Party, so we don't yet really know what the platform's going to look like. But I think that those two things are going to be important. It's possible that we may see as we get towards November convergence between the two parties, both in terms of the way they look at the demand side and the response to the pandemic and the supply side and the energy transition, or we may see really divergence on either one or both of those. And I really don't know which one that will be.
Yeah, I'm quite keen to see where the whole narrative around the phrase energy independence, which has become a bit of a clarion call in US politics, and obviously with it a whole array of policies, but clearly it stands out as one of those very significant ambitions. But that's perhaps for another day, Martin. Listen, thank you so much. We could chat all day on that. Martin Fraenkel, President of S&P Global Platts, thank you for being on Halftime Talk this week. And we look forward to coming back to some of these topics in the second half of the year. But until then, thank you for being with us.
Thanks for having me, Sean. A pleasure.